Welcome to Bits of Wisdom, offering insights on money, Bitcoin, and the world of exponential change. Hello, and welcome back to Bits of Wisdom. I'm Paul Rogers, and welcome to episode 5 of our series on money, our monetary system, and Bitcoin. So in the last episode, and I just want to reinforce, let's think about this. Money was in essence gold. In 1933, the president said, you're going to have to turn all your gold into the government, and we'll give you pieces of paper worth 41% less gold than it used to be. But you could still convert it into hard money, gold, until Richard Nixon said, no, you can't. And then finally, Gerald Ford said, well, you can, but as it turns out, the price of gold started shooting up. So what was happening when Roosevelt changed the system? Well, we had to fund a great deal of social programs coming out of the Great Depression. When Nixon changed the system and took us off the gold standard, we were also funding great social programs for the Great Society and funding a very expensive war in Vietnam, all of which was followed by soaring inflation, the likes we have not seen until now. So in this episode, and with that backdrop, we're going to take another side tunnel down into our banking system. Fractional reserve banking sounds exciting, I know. And then, it's a wonderful life until there's a run on the bank, which leads us to FDIC insurance and the question of how safe do you feel at the bank? So let's talk a little bit more about our banking system before we talk a little bit more about fiat currency. So what's a bank and how do they work? Well, they take deposits and store money. As a bank is a place where depositors put their money because it's safer and more convenient than putting it under the mattress or in the backyard. And over time, banks have developed many methods to make transactions faster and more convenient, from checks to credit cards, wire transfers, etc. Transactions flow through banks, and banks settle transactions between parties, regardless of which bank their money is deposited in. Think about this for a second. It's a very useful service. So for example, if I have an account at Bank A and I give a check to the grocery store, and the store has its account at Bank B, the two banks have to settle the transaction between them. It's not as simple as taking the money, a debit, from my account at Bank A and moving it or crediting it to the grocery store's account at Bank A because they don't have one there. And that's one of the purposes of the Federal Reserve Bank, especially when these banks may be at long distance or don't have relationships with each other. That's what's known as the clearinghouse between banks. So banks, of course, also make loans. Banks loan money to people to buy houses, cars, to start or expand businesses. So if Allison goes to a bank for a loan of $100,000, one might think that the bank takes $100,000 of depositors' money and makes the loan. The bank would then have $100,000 less in its vault. So what would happen if the depositor wanted their money back? It's not there, right? Remember the movie It's a Wonderful Life with Jimmy Stewart explains the money isn't here, it's in so-and-so's house and so-and-so's business? Now, an economist, and stay with me here, would categorize this as a mismatch between the time dimensions of deposits and loans. For example, if you went to the bank and took out a 5-year certificate of deposit, that generally means the bank can expect to have that money for 5 years, in which case they could match that with a loan for a period of 5 years. But that would limit banks to only loaning out depositors' money. And as we all know, not that there's anything necessarily wrong with it, but banks make money by loaning out money. And what's really cool is they loan out money they don't have. Curiouser and Curiouser, cried Alice. So let's talk about fractional reserve banking. Sounds sexy, doesn't it? Well, if you're a banker, it sure is. You see, a bank only keeps a fraction of their depositors' money in reserve for when the depositors want to take money out of the system, hence fractional reserve banking. So here's the nifty trick. If the bank has $100,000 of my money on deposit, and they only have to keep 10% in reserve if I want some back, they can loan out $90,000 or more of money. So let's say 10 people have $100,000 each in the bank for a total deposit base of $1 million. And if the bank only keeps 10% in reserve, they can loan out $900,000. So depositors have accounts worth $1 million at the bank, but let's say all the people who borrowed money deposited their funds and their accounts were credited with the other $900,000. I mean, that's what happens when you get a loan. You get to deposit it in your bank. So now there are $1.9 million worth of deposits credited on the bank's balance sheets. The bank just created money out of thin air. While there's a loan balance that maybe will be paid back, the account balances are $1.9 million. And guess what? Now the bank can create loans on the 10% reserve of that money. And it keeps going on, and the game keeps going on until it doesn't. Hence, we have the concept of bank runs and FDIC insurance. So let's go back to that movie, It's a Wonderful Life. There was a run on the banks, just as there have been many times in our history and in other countries' history, because people didn't have confidence in the banks and the system. And they wanted their money now, and they wanted it out of the system, which historically at least could be converted into gold or silver. Forms of this have happened many times and in many societies. So after the Great Depression in 1933, when there were bank runs and the banks didn't have enough money, FDR created the Federal Deposit Insurance Corporation to return trust to the system, while of course also banning the private ownership of gold, as we previously discussed. So the government basically said, hey, trust the banks, because if they have a problem, we will give you your money back. Well, up to those well-known limits of about $250,000 per account now. So I guess this means that the FDIC has enough money in its vaults to cover all the deposits, right? You've got to be kidding me. Confidence games work for a reason. And as long as there's confidence in the game and the scheme, it can continue. And the element of confidence depends on how well you sell it. And banks and the government have done a fantastic job of selling FDIC insurance, haven't they? Now, FDIC insurance can work well and be a safeguard to depositors, especially at things right now like small local banks that could get into trouble due to bad loans or changing economic conditions in a local environment. But when you look at the safeguard of insurance that's supposed to be provided for the big banks, we are talking a different ballgame. The 10 biggest banks in the U.S. have nearly half of the total deposits. The top 5 have deposits of about $7.5 trillion. What happened if one of these guys gets into trouble? And by the way, we saw this in the financial crisis of 08 and 09, which we'll talk about a little bit more in a future episode. They're all intertwined. So if one goes down, they pretty much all go down. Hence the term, too big to fail. So how much in reserve does the FDIC have to cover all this risk? Well, after the financial crisis of 08 and 09, Congress stepped in and passed the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. And among other things, it provided the following. It provided a minimum designated reserve ratio of 1.35% of estimated insured deposits. But have no fear, if the ratio fell below 1.35%, or the FDIC projected it would, they would have had to adopt a restoration plan to return the reserves to that ratio within 8 years. Now, we can take some comfort because the reserve ratio is not quite that low. They've held it at about 2% for the last few years. And they've explained that they look at that target ratio as the minimum level needed to withstand future crises of the magnitude of past crises. Now do you feel safe at the bank? minimum ratio, the magnitude of past crises. The thing is, the crises keep getting bigger and bigger and bigger. All right? Now, I'm not saying don't keep your money in the bank. I'm just explaining to you how the system works so you can evaluate the risks. The US dollar and US banks are widely regarded as the best and safest ways to save your money. That is either comforting or even more worrisome. Now, again, don't get me wrong. I think the FDIC and the US would make good on all of these deposits should there be a problem. Because you see, they have a magician on staff. And that's what we'll talk about in the next episode. So again, I'm Paul Rogers. This is Bits of Wisdom. Thanks for joining me. We'll see you next time.